Hey there, my name is Robert Reynolds, and in today's video we're going to be looking at something that's very important for investors: how to understand and read an income statement. By the end of this video, you'll be a pro. Grab a coffee, take a seat, and relax, and let's get straight into it. Let's make this really simple. Let's break it down into two different segments. Segment 1, what does each section of the income statement tell us? Segment number 2, when we're evaluating a business, how can we use this information to make better decisions? Let's get straight into it. All of this information was downloaded from Ticker Terminal. Ticker Terminal is a fabulous resource. I use it every day. It's got 15 years worth of data on balance sheets, income statements, cash flow statements, so you can better understand and plot out the trend in different margins. And that's very important because it gives us an idea of the quality of management, pricing power of a product, etc., which we're going to get into in just a moment. If you're interested, I believe they've got a freemium version, a fabulous resource, and we'd really appreciate if you used our link in the description. Let's get straight into it. Section 1 of the income statement is gross profit. Very simple, direct related costs to production and sales. I produce a product, I sell it, what's the difference? That's your gross profit. Gross profit includes not just raw materials. If I'm building maybe some sort of confectionery product, I might need chemicals. It's not just those raw materials. It's also direct labor to produce that product. So there is any cost that's associated with directly producing that product is what's known as the cost of goods sold. We take that away from revenue and we get what's known as our gross margin, our gross profit. That's the first section. The second section, now if I have a product, let's say I bake a loaf of bread, people are not going to knock on my door in order to buy that loaf of bread. So I gotta put the message out there that, hey, I sell loaves of bread, pop on over and I'll sell you my loaf of bread. So you've got maybe more expenses such as selling and marketing. You've got customer service if there's a problem with your product. So there are more expenses that are incurred from an operational perspective that also need to be factored in. These incurred costs are to maintain operations, whether it's customer service, selling and general administration, research and development. If there's a high capital expenditure budget, we also factor in depreciation and amortization. Non-cash expenses, they don't really exist. You buy an asset, you depreciate it over 20 years, but every single year you can write a little bit off. There's a couple of different ways in which you can depreciate it. Each business uses a different method, but the point is that we can write that asset off over time. It's a non-cash expense that also goes into operating expenses. So first one, direct costs. Secondly, indirect costs, such as marketing and sales, which are also real expenses in order to move the product. The operating income, the operating margins are very important because it gives us a fairer reflection of the profitability of the business after all the expenses in order to sell a product. However, the expenses don't end there. We also have real expenses such as interest. Depending on the capital structure of the business, if they have a lot of debt, that interest is absolutely a real expense. We've got to factor that in. And if they're showing a profit, tax is unavoidable. So interest and tax need to be included as well. And in tandem with that, you got one-time expenses. Asset write-down as an example. Let's say I went out and bought an asset for $100. It's not worth $100 anymore. It's worth $0. I'll write that down as a one-time expense. That's not recurring. One-time expenses or unusual expenses are also included here. Impairment of goodwill. Let's say there's a row of houses, 10 houses. They're all worth $100,000, but I go out and I want to buy one. And I want to buy one, specifically one, and the owner doesn't want to sell. So I got to say, hey, listen, your house is worth $100,000, but I really want it, so I'll pay $120,000. You end up with a situation where your balance sheet looks like $100,000 in assets, $20,000 in goodwill. Now, if you want to recognize that goodwill, that goes into unusual expenses, impairment of goodwill. So let's start off section number 2 at the very top of the income statement. We're going to start off with gross margins. To me, gross margins are very important to analyze, not for valuation of a business, but more so for efficiencies, both from management, but also quality of product. So if you think about it this way, the direct expenses to develop a product is the cost of goods sold minus your sales. Let's say the margin is 50%. If, let's say there's $100 in sales, $50 in gross profit, let's say 1 year later, for every $100 of sales, you made $55 in gross profit. How could that occur? The first way could be they pass on higher prices, meaning that your product is so good that even though you raise your prices, the customer still wants to pay for it. So you got pricing power because you've got a good quality product. As well as that, we might have a situation where management recognize an opportunity to implement economies of scale. What does that mean? Well, if they increase their purchase order, the cost might actually go down, meaning that from a cost perspective, management are being far more efficient in spotting opportunities. So what gross profit can actually tell us about a business? If it's trending higher, it could tell us, one, it's a quality product, and or quality management because their cost control is very good. So cost savings or pricing power, very important, and that's what comes from the gross profit margin. It can also be an indication of a business that might be some sort of inflation hedge. Let me give you a very, very rudimentary example of this. So we got two different companies here. We got company A and we got company B. And I'm going to break down, again, a very rudimentary example. You need to understand, obviously, the market. What is it? A monopoly, oligopoly is a perfectly competitive market. There's a number of stuff that needs to go into the analysis. But let me give you an example of what a high gross margin, why it'd be more favorable during heightened inflationary times. Again, very rudimentary, but I think it's going to prove the point here. So company A here has revenue of $100. And the cost of goods sold are $30, meaning the gross profit is $70 or 70%. Very simple stuff. With 10% inflation, the direct costs to produce that product just increase 10%. So let's say you don't change the sales price, but your costs are increasing. So your $100 of revenue is now costing you $33 in direct expenses, the cost of goods sold. Meaning your profit margin, your gross profit margin goes from $70 down to $67. It's down 4.3% your profitability due to a 10% inflation hike. Now in company B, so this is an example of a company that has a higher gross margin. Company B doesn't have that luxury. Company B has $100 in revenue and $80 in cost of goods sold. It's got a 20% gross margin. They make $20 in profit. With 10% inflation, you have $100 in revenue. You now have $88 in expenses directly related to selling that product, or to making that product, excuse me. So your gross profit's now $12. That's a 40% drop because your margin is a hell of a lot lower. The reason why this is important, if the product is good quality, yes, you can pass on higher costs, but look at the gap between the low margin product and the high margin product. You don't need to pass on huge amount of price hikes just to offset this decline in profitability, whereas with company number B, you got to factor in massive price hikes to offset a 40% decline in your profitability. So that's crucially important to recognize. The quality of the product is very important, but the higher margin companies should do a little bit better in passing on those costs. So gross margins can give us an indication. If we have a high gross margin in a higher inflationary world, it might actually fare up an awful lot better than a lower margin business for those reasons. Next, we're going to talk about income tax. This red line here, depreciation and amortization are non-cash expenses. We go over that a little bit more in the cash flow statement. If you want to check it out, there's a link just above. Depreciation and amortization. Let's say I bought an asset. Let's say I bought a van in order to deliver my goods as a business. So that van will last 10 years and I pay $10,000 for that. Well, in 10 years, I'm going to have to replace that van. So I pay $10,000 today, and every year for the next 10 years, I will depreciate that van by $1,000 each for the next 10 years. It's an expense because I need to replace it at the end of the 10-year mark. The cash, the investment is up front, so this is a non-cash expense. Every year, I'm writing that van down a little bit. So this here is what's known as a non-cash expense. There's maintenance capital expenditure and there's growth capital expenditure. So this could be a good hack, like what Amazon have been doing for the last 10 or 20 years. Increase your capital expenditure, so much so that your depreciation absolutely outweighs your net income, and then your tax expense goes to zero. So that's one example. When you're looking at something like Amazon, you'll see EBITDA, which factors in depreciation and amortization. The enterprise value to EBITDA is 14, 15 times, but the price to earnings is 100 times. Why? Depreciation and amortization is a non-cash expense, and that can be essentially overshadowing the tax. So that's important to recognize. There's also stock-based compensation, which is a real expense because the outstanding shares increase, but there are a number of non-cash expenses that can be used in order to offset taxes. Next, we're going to talk about operating margins. Operating margins, very important, and the reason being is if you have a very high gross profit margin and a very low operating margin, what does it tell you? It tells you that the business is probably operating in a very, very competitive market and they don't necessarily have pricing power. And the reason being is maybe customer acquisition cost is very high in that highly competitive market. Now, if the margins are very high, and not necessarily like gross margins, but higher, it might be some sort of sign that it's a duopoly, oligopoly, maybe a monopolistic type market. So when we're looking at SG&A, if it's incredibly high, it might be the case that, yes, the product's cheap to make, but it's very expensive to sell because there's another 1,000 companies I'm competing with, and we're all competing for the same eyeballs. So you might see a high gross profit, and you might see a lower operating profit, and that might be got to do with barriers to entry. So looking at the difference between gross profit and operating profit is very important. Secondly, capital expenditure and R&D is reinvestment. It's reinvestment or maintenance expenses. As I mentioned a moment ago, if you need a van to deliver your goods and services, after that van breaks down in 10 years, you got to replace it. Is it going to give you any more growth on the top line? No, but you still have that upfront cost to replace the van. That's more maintenance capital expenditure. However, let's say I own something like Amazon AWS and we're only operating in the United States, but if we build out infrastructure in the rest of the world, we can serve a new market. So I can start increasing my capital expenditure, pushing it into the international markets, and what that'll do for me as a business, it will grow my top line and bottom line over time as we reinvest into the business. So recognizing capital expenditure and R&D as reinvestment for growth or maintenance capital expenditure is very important. There are two different examples. Let's say I own a bakery, I need a van to deliver my bread. I'm always going to need a van. It's not going to give me incremental growth. But if I build a new, whatever it may be, and that gives me incremental growth longer term above and beyond the invested capital, well, that will be more reinvestment into the business and absolutely welcome. So these are things that you can recognize from operating margins. There are many different operating efficiency metrics like inventory turnover, asset turnover, interest expense. All of these will take information away from the financial statements and will give us more information about the business. Are these assets efficiently working for me with depreciation and amortization? Well, the asset turnover is, for my assets, how many times can I turn over the revenue? Obviously, the higher the better because it's asset-light business. But these are ratios that we can start calculating based on the financial statements. Understanding what it tells us is step number one. Taking this information and using it to better understand the business is step number two. And again, we've got tutorials on that. All of these give you a little bit more information. If you're interested, we also cover the balance sheet and the cash flow statement here on the channel. Thank you very much for your support and have a great day.